Good morning and welcome to the SCRA webinar, Utilizing State Credits and Incentives. My name is John Searcy. I serve as SCRA's Director of Finance and Administration, and I will be the moderator for this webinar. Our speakers, Will Clark and Nick Cousineau of Elliott Davis, have put together an excellent presentation for you today. Take it away, Will.
Alrighty, thank you so much. Well, thank you for the introduction, John. I appreciate SCRA inviting us to participate in your webinar series. Elliott Davis is thankful for the partnership, and we look forward to building on it in the future. Nick and I are managers in Elliott Davis's state and local tax practice. We specialize in state tax credits and incentives throughout our market territory. Elliott Davis is comprised of a team of nearly 750 trusted advisors with our headquarters in Greenville, South Carolina. We have 9 offices throughout the Southeast. We use a diverse experience to solve rapidly evolving and complex business issues. Today, we're going to cover some key opportunities for startups and small businesses in South Carolina. I note that SCRA's mission is fueling South Carolina's innovation economy. I would certainly propose to you today that each of these opportunities we will cover this morning have the ability to directly fuel business innovation through the use of South Carolina's state tax savings. Now, I want to remind you that the material that we're covering this morning is a summary of various state tax credits and incentives. It is only a summary, and we would recommend you not rely on the summary material upon making tax decisions. It's very a nuanced and complex area. We would simply advise you to seek the advice of your tax professionals or specialists in this area. Alrighty. We've obviously already covered the presenters. We're happy to be here. And now let's go ahead and dive into the material. This morning, we're going to cover statutory tax credits for businesses, statutory tax credits for investors, and a high-level look at South Carolina's property tax regime and the benefits that it would have for small businesses. So the key opportunities we're going to look at: job tax credits, capital investment tax credits, research expense credits, and the angel investor credit. From here, I'd like to go ahead and hand it over to my colleague, Nick, and he's going to take it away covering South Carolina's job tax credits.
Great. Thank you, Will, and thank you, SCRA, for having us this morning, and good morning to everyone on the call. The South Carolina Jobs Tax Credit offers a tax break to companies who are increasing their overall employee level in the state. It is uniquely valuable in that once a company qualifies for the credit, it may earn the credit for 5 or more years on the jobs created. There are 3 styles of jobs tax credit, or the JTC, as we've commonly referred to it: the traditional JTC, the annual small business JTC, and the accelerated JTC. Of the 2 small business jobs tax credits, the accelerated JTC is overwhelmingly utilized compared to the annual small business credit. And the traditional and accelerated small business JTCs are the 2 that we'll be focused on today. All of the JTCs may be used against South Carolina income tax, bank tax, or the insurance premium tax. Note that it may not be used against the South Carolina corporate license fee. Further, it is limited annually to the lesser of the available credit, or 50% of the tax liability. Unused credits, however, may be carried forward for 10 years. Also keep in mind that this credit is non-discretionary, meaning that no prior approval is needed from the taxing authority so long as the company can qualify. Corporations, sole proprietorships, partnerships, S corporations, limited liability companies are eligible to take the credit. And in order to qualify for the jobs tax credit, any of the 3, a business must be a certain type of business, and it must create and maintain a required minimum number of new full-time jobs, which we will define in a moment. Each qualifying new job creates a credit worth between $750 and $25,000 per new job, depending on the county in which the business is located in. Obviously, this is a wide range, and we will go through the credit amounts on a county by county basis here shortly. All right, so this slide lists the types of businesses or the industry that the business must be in order to qualify for the credit. As you would expect, labor-intensive industries such as manufacturing, warehousing and distribution, agricultural businesses are prime candidates for the JTC, and of our client bases, a lot of manufacturers are taking this credit. Often overlooked, however, is the fact that almost all medical-related facilities and service providers qualify, and that's by statutory definition under the somewhat obliquely named qualified service related facility category listed on the lower left hand there. Additionally, many businesses may fully or in part qualify as an R&D facility or a technology intensive facility if they have a designated space for such activities. The corporate office facility is another category many businesses can qualify under if the office is a headquarters style office, and that can be either regional or worldwide, or if you only have one office for your business, that's your headquarters. Missing from the list is retail and service facilities. So those businesses normally do not qualify if you're in retail sales or retail services. However, if you are in a tier 4 county, any business may qualify in a tier 4 county, including retail and service businesses. And we'll get to the county tiers in a moment here. All right, so the traditional jobs tax credit requires that the company create 10 new full-time jobs. New jobs are determined by comparing the monthly average of full-time employees subject to South Carolina withholding tax in a given year to the prior year. So if you have an average of 20 employees in your previous year, and you had a hiring spree the next year, and you on average had 10 more employees at the end of the year compared to last year, then you would qualify for this credit. If a minimum of 10 new jobs are created in year 1, credit for each of those jobs can be taken in years 2 through 6. So there is a time lapse. Those jobs need to be maintained for a year in order for the company to start earning that tax credit. A taxpayer may claim credit only for job levels maintained in the tax year that the credit is claimed. So if you fall below the required number of jobs for the traditional jobs tax credit, that would be 10, then you may not take any credit at all. Incremental jobs, once you qualify for the credit, once you create those 10 new jobs in the first year, any incremental jobs over the next 5 years, though, may qualify for the credit as well. So if you create those 10 new jobs in year 1 and in year 2, those jobs are maintained. If you increase your overall employee level by another 1 or 2 employees, those 1 or 2 jobs will qualify for the credit as well. As mentioned previously, the credit is limited to 50% of the taxpayer's South Carolina tax liability. For a corporation, obviously they're taxed at the entity level, so it limits your corporate income tax. And then if you are an owner of a pass-through, that can be used against your individual income tax, and that's limited to 50%. Any unused credit may be carried forward for 15 years, and any 2 half-time jobs may be qualified for 1 full-time job. All right, next slide, Will. Thanks. All right, so the small business jobs tax credit. So the big difference between the annual small business tax credit and the accelerated small business tax credit is that the accelerated small business tax credit can be used immediately in the year that the jobs are created. That's why we never see anybody use the small annual jobs tax credit, or almost anybody anymore, just because you can have that immediate tax savings. It is limited to employers with 100 or less than 100 employees, and that is not just employees in South Carolina, but that is worldwide employees. So if a company has only, say, 10 employees in South Carolina but has 150 in Georgia, they do not qualify for the accelerated small business jobs tax credit. The other thing that is unique about the small business jobs tax credit compared to the traditional JTC is that instead of creating 10 new jobs in year one, that business only needs to create a net average of 2 new jobs in the year, and you're qualified. You still need to be a qualifying business type. That doesn't change, but instead of creating 10 new jobs, you only need to create 2. So a lot more businesses obviously qualify, especially the smaller businesses that are growing quickly. Small companies with high-paying jobs are especially benefit from the small business tax credit. Under the accelerated small business JTC, the company may only get the full credit amounts if the new net job pays 120% of the county average hourly rate. So that every year the Department of Revenue, twice a year, publishes a list of per capita wages by county, and those jobs must be above and beyond that in order for the credit to receive full credit. Otherwise, they can still receive 50% for any job that falls under that wage level. Here's the definition of full-time jobs. A full-time job is one in which the employee normally works 35 hours a week for the normal year of company operations. 2 half-time jobs, which would be a minimum of 20 hours, between 20 and 35, can count as one full-time job for the credit calculation purpose. Seasonal employees can count, and we see that in agribusinesses, anything to do with agricultural jobs. So a new job is created in the state at the time a new facility or an expansion is initially staffed. That does not mean that, basically there's an expansion anytime you're hiring either, a net 2 new jobs or net 10 new jobs, you can qualify for the credit. So there's kind of some opaque language there, but anytime that you are hiring, that can be considered an expansion for the credit purposes. So here are the county tiers along with the credit amounts for 2021. These are pretty similar to 2020, although a few counties did shift. Notably Spartanburg, which was previously a tier 1 county, has dropped down to a tier 2 county. So their credit is now worth $2,750 versus $1,500 last year. So just keep that in mind. But obviously in the tier 1, you've got the Aikens, Greenville, Lexington, Richland, Beaufort, Berkeley, et cetera, Charleston. And then we go all the way down to tier 4. And you'll notice that it's $25,000 credit per new full-time job if you're hiring in Allendale, Bamberg, Barnell, Chester, Dillon, et cetera. We got a question: does full-time jobs require benefits? No. So in a lot of other states like Georgia, if you're familiar with their jobs tax credit, there are some minimum benefits that need to be offered to employees. But in South Carolina, a full-time job does not require that benefits be offered to take the credit. All right, so as mentioned previously, if you are taking the accelerated small business jobs tax credit and you're not paying 120% of the per capita wage for the state or county, you will receive 50% of the credit for those jobs. So, if the full credit is $1,500 in tier 1, that's going to be $750 for tier 1. And then going through tiers 2, 3, and 4, you just take half. So it goes from $1,375 in tier 2, $10,125 in tier 3, to $12,500 per job in tier 4. There's also a $1,000 bonus per job if you are located in a multi-county industrial park or multi-county, a business in an industrial park jointly established by counties, or if you're on a brownfield location. So if you're on a cleaned up brownfield location, you also receive a $1,000 bonus. So if you're thinking about moving, especially into one of the, we have a lot of businesses currently moving into old mills around Greenville. That could potentially be a brownfield site that you talk to your real estate developer about. So here's a quick example scenario. You have a small agribusiness that's starting up in Orangeburg County, which is tier 4, and that means it's $25,000 of credit for 2020 and for 2021. If that business added an average of 4 new jobs in 2020, and all of those jobs were 120% of the county per capita wages, and for Orangeburg, all those jobs would have to pay at least $42,787 per job. So not a real high amount. Each of those jobs would fully qualify for the full credit. In year one alone, the jobs tax credit generated from just those 4 employees would be $100,000. So $25,000 per new job per year. Cumulatively, over the 5 years that those jobs can earn credit for the business, $500,000 jobs tax credit are going to be generated if those jobs are maintained, and that's not counting any incremental jobs that this employer would be adding over that 5-year period, which could also be eligible for credits as well. Like I said previously, the credits can be carried forward for up to 15 years, and again, they're limited to 50% of the tax liability per year.
Nick?
Yes, sir.
A question came in, perhaps I missed. Do these tax credits all need to be taken in that year, or is there a carryover?
Yes, there is a credit carryover. So any unused amount can be carried forward for 15 years. So you're limited to 50% of your tax liability, or if your tax liability is greater than your or if the credit you're earning is less than 50% of your tax liability, you can take the entire credit in 1 year. If you're in Orangeburg and you're generating hundreds of $1,000s of jobs tax credit every year, you're likely going to be limited depending on your business, and you can carry that forward for 15 years. All right, next slide, Will. Great. Here's just a quick overview of kind of where the Tier 4 counties are located. Obviously, with $25,000 of credit per job, it's nice to know where you can set up shop and start earning some serious jobs tax credits. A lot of these Tier 4 counties are located right along major interstate highways, and we just wanted to highlight that for you.
Yep, absolutely. Well, thank you, Nick. I appreciate you covering the job tax credit piece for us. Before I get into the other credit opportunities, I do want to let's take a step back and let's summarize here. So Nick covered some excellent pieces on the job tax credit, but let's think big picture here. Big picture wrap up for job tax credits. What we want to see is the creation of new jobs in South Carolina. That was the whole goal of the General Assembly, to create the job tax credit program. So you want to see a minimum of 2 new jobs created in South Carolina. Those new jobs, wherever they're created, as long as it's an eligible business type, which 9 times out of 10, unless it's a retail convenience store, 9 times out of 10, we can get you qualified for job tax credit. So again, those job tax credits are earned by the creation of new jobs, a minimum of 2 new jobs if you're a small business. And really, it depends on the county location. So if you're in a rural counties, obviously the credits are higher. Your more established, more affluent counties, your Greenvilles and Charleston, those credits are lower. But ultimately, if you are a pass-through entity, I know this was one of the questions that popped up. If you're a pass-through entity, S Corp or LLC, those pass-through entities, those credits actually pass through directly to the owners. So the owners take that credit on your South Carolina 1040 return. So if you have other items of income on your South Carolina 1040, those credits will also offset any tax liability that you owe on those on your South Carolina 1040. So it's an excellent opportunity to take advantage of these credits, even if your operation is a small startup, even if you're not very profitable at first. You still need to generate those credits because, one, you can use them at a pass-through level, pass them through to the individual owner, and 2, they carry forward for 15 years. So Nick and I don't have a crystal ball. I wish we did, but if we did have a crystal ball, we could tell whether or not you'd use them in the future. Now we don't. So it's certainly worthwhile to, generate these credits and hold on to them, and certainly pass them through. Nick and I do cover a good number of nuanced and specific areas in our daily practice. So if you have any specific areas or questions on your industry type, certainly feel free to shoot us an email. We do have some white paper material we'll be glad to share with you on this if this is something that's of more interest to you. But on this map, I propose to you that any of these areas in green, these are the rural counties that would really love to have your business, really love to see some industry, innovation, development, startups along these corridors. A lot of these are corridors that are heavily traveled, I-95, I-26. Those corridors would be great areas for development and for new businesses. So please keep that in mind. Please reach out to us if you need assistance. We're happy to help in this area and get things moving for you.
Those are great points, Will. And I'll just add one other thing in that there is the ability to go back and amend your tax returns or establish a jobs tax credit in prior years. It's not merely a look forward. If you had a big hiring event a couple of years ago, or three to even 5 years ago, we can potentially make that work out and generate credits either to amend your return or for use in the future.
Awesome. Well, and I see two questions that just popped in. So let's tackle those now because they're actually relevant to what we were covering for the job tax credits. The first question was, what if your employees work primarily from home? What county counts for the credit? Well, we're seeing that a lot now because of the COVID environment and everything's changing. A lot of people working from home. We're no different. We enjoy working from home. Really, the way we handle that and the ways so we've gotten some informal guidance from the Department of Revenue is really, what is the primary business location? Where does the business have a primary facility? And so if those employees could report to that facility, if you report to that facility on a regular basis, if they were required to report to the facility, except for the fact that COVID makes them work from home, that type of thing, we look to that facility location. So, we look to the facility location. The credit is actually determined on a county by county basis. So what we would do is we would look at your county employee headcount. So wherever your employees are sourced to for a county by county location, if they have to report to Richland County for meetings on a regular basis, we would likely source them to Richland County, that type of approach. It is not based off of where they live and what county they live. Rather, it is based off of the county where they would report to for a work meeting or a business meeting, or if they were regularly in the office. I think I covered both of those. Nick, is there anything else you want to cover?
I don't think so at this time.
Okay. All right. So, I see a few more questions that are coming in. They may be a little bit more specific in nature to your business, so maybe we can cover those at the end if they want to certainly shoot us an email. Let's go ahead and jump right into the capital investment credit, and we will cover this one. So the capital investment credit is one that the General Assembly created to reward the investment in capital equipment. If you have a startup business, if you're starting up a manufacturing or production facility, they want to reward you for, investing in that capital, investing your capital in that manufacturing equipment. So what we have here is a income tax credit for qualified manufacturing and productive facilities where that equipment that you purchase that's placed into service in South Carolina, you get an income tax credit on that basis of that property. The credit's really between 1% to 2.5% of the cost basis. The credit's determined based off the class life of the property. We have 5, 7, 10, 15-year property. So depending on the class life of the property, you get that credit. The credit has a 10-year carry forward period and can offset up to 100% of your South Carolina income tax liability in each year. Again, if you're a pass-through or LLC, that would obviously pass through to the individual owners. So again, this is a great opportunity for somebody that's starting up and need to put in some productive equipment if you're manufacturing or producing something. The code simply says that it needs to be integral to the manufacturing or productive process. So I'm not sure if a PlayStation or some fancy computer system would be integral to the manufacturing process. You need to have something that is simply integral and assist with the manufacturing or productive functions of your facility. Another credit we see frequently is the South Carolina Research and Development Credit. Obviously, this is one that certainly is beneficial in the innovation area. We're glad to see that South Carolina has this out there. It simply mirrors the federal R&D credit. We do see that a lot of businesses and innovation take the federal R&D credit. It's really simply a study of your research expenses, your development expenses, and classifying them and quantifying them. So South Carolina mirrors that, and they have a income tax credit up to 5% of your expenses incurred in South Carolina. The cool thing of this credit is simply it can offset your income taxes or your corporate license fees. Now, I know that some of us may understand that corporate license fee, it is a nuanced area in the fact that if you have a bunch of paid-in capital, a bunch of capital invested in your company, but you're not generating a profit, unfortunately in South Carolina, you still have to pay a corporate license fee on that capital invested in your company. So this credit, this R&D credit, will actually help you offset that tax liability, or I guess you could say that corporate license fee liability. So this credit can be carried forward up to 10 years, and it can offset up to 50% of that liability. So, if you're taking the federal R&D credit, you certainly should be taking the research and development credit, and on your business's return. So the three credits we just covered, the capital investment credit, the angel investor credit, and the job tax credit, those are all credits that ones that the business could take. Businesses should be taking them. If you're engaged in any of those activities, you really should be taking those. If you haven't taken those, review your past returns, and you do have the opportunity to amend your returns to pick up those credits if you think you qualify. South Carolina has a statute of limitations of 3 years, so you can go back 3 years and claim those credits as long as you're eligible, as long as you qualify. I want to mention now another one that is the angel investor credit, which it encourages investment into your business. So if you're looking for capital investment, if you're looking for investors in your business, this credit encourages angel investors to invest in your business. The credit is 35% of that investor's qualified investment. So it's very, very beneficial for both the business that's trying to get going, get up on its feet, and the investor that sees value and sees opportunity in your business. There's some applications you have to certainly apply. The business has to meet the qualification criteria through the South Carolina Secretary of State. You have to submit application through the Department of Revenue. So there's a number of hoops you have to jump through, but it's certainly worthwhile, and certainly one that we would encourage you to go after if you're seeking new investment in your business. It's very worthwhile. Qualified businesses are manufacturing, distribution, your software development, your research and development. Any of those categories meet the angel investor criteria credit, and in addition, you meet all the other eligibility criteria for the other credits we talked about earlier. So you really can pair them up and stack them up and really get some great opportunities going with these incentives for business development in South Carolina. Again, there's a number of nuanced areas. I'm not going to cover everything. The slides are here. Please reach out to us if you want the slide deck, and we'll be happy to send them on to you. Some additional incentives we see, I'm just going to cover them briefly, and reach out to us if you have additional questions. We see credits for corporate headquarters. If you establish your corporate headquarters in the state, there's credits for that. If you have to put in infrastructure for your new facility, water lines, sewer lines, there's income tax credits for that. Another piece that Nick's going to cover on our last 10 minutes is some property tax opportunities. There's definitely some property tax opportunities out there if you set up a new facility, and those are worthwhile chasing after as well. We do see some incentives out there for abandoned buildings. A lot of startups and new businesses take over abandoned buildings and revitalize them. Excellent opportunities to revitalize abandoned buildings, historic structures. All those are out there to take advantage of, and we encourage you to do so. They're very nuanced and specialized areas, so please make sure you're covering all your bases when you're doing it and working with somebody that knows what they're doing. One final thing I would mention is the port volume increase credit. One is we see this missed a lot. We hate to see it, but if you are importing or exporting through the ports of South Carolina, your Port of Charleston, your inland ports, please make sure you're taking advantage of the port volume credits, because this is simply the way the South Carolina's Coordinating Council for Economic Development is rewarding you for utilizing the South Carolina ports. We want to see the port volumes increase in our state, bringing our goods in and out of the state. It's an excellent opportunity. Please take advantage of that. I want to hand it over to Nick. We have the last 10 minutes or so. Let Nick touch on some property tax opportunities. After that, we will wrap it up. We will close it out. We'll share our contact information. Please feel free to shoot us emails, and we'll leave the last 10 minutes or so to open it up for questions. We'll take them on Q&A, and we'll answer as many questions as we can. Nick, take it away.
Great. Thanks again, Will. And thank you for going over all those additional opportunities. Just real quick, North Carolina, for instance, has recently simplified their tax code and got rid of a lot of credits and incentives. But as you can tell, South Carolina has not simplified recently, and there are lots and lots of tax savings opportunities if you know about them and if you apply for them. So do take a look at the many opportunities that are out there that may not present themselves to you in an obvious way. Switching from kind of the income taxes and direct taxes, we're going to go over to property taxes. Property taxes are an often overlooked area of the business's tax expense, and thus represent a great tax savings opportunity. We're going to briefly cover the basics of how the South Carolina property taxes work, and we're going to also highlight some opportunities to save on property taxes as well. So just going over the basics, real property, land, building, etc., and business personal property and certain what we're going to call personal property are subject to South Carolina property taxes. Examples of certain personal property are boats, vehicles, airplanes that are used for personal uses. We're not going to talk about those much today, but I thought I'd mention those. Note that business inventory and supplies are not taxable as business personal property in South Carolina. Lots of states do, but South Carolina does not. So keep that in mind. And there's no special free port exemption like they have in Georgia that you need to apply for. They're not taxable by statute. The formula for calculating property taxes is the same for both real and personal property and is as follows. It's the fair market value multiplied by the assessment ratio multiplied by the millage rate. And that gives you your property taxes or your ad valorem tax, as you might see referenced in certain literature. In general, commercial real property is assessed at 6%. So in that formula, the assessment ratio would be 6% for most commercial real property, while manufacturing property is going to be assessed at 10.5%. This is being effectively lowered through some workaround legislation to 9% by 2020, property tax year 2023. But you will still see 10.5% on your tax bill. Both commercial and manufacturing personal property is assessed at 10.5%. Commercial non-manufacturing personal property is reported annually on the South Carolina Form PT 100, while manufacturers and fee in lieu of tax or FILO holders file the South Carolina Form PT 300. And those are normally due April 30th for calendar year taxpayers. Keep in mind that the county, can we go back one slide, Will? The county and or Department of Revenue appraiser determines the fair market value of real property, and there's a 5-year appraisal cycle for real property. So every 5 years, your property will be reappraised either by the county or the Department of Revenue. And the fair market value of personal property closely follows the valuation as determined under South Carolina income tax rules. And basically what the fair market value for personal property is going to be the business's original basis or their original cost in the asset, net of allowable depreciation, and that often usually follows income tax depreciation. And just a quick note that while depreciation is taken into account for personal property, it is not an explicit factor in determining the value of real property. Again, real property is going to be appraised by an appraiser. And the residual taxable value of personal property is always going to be 10%. So as long as that asset is on your books, you're always going to be taxed on 10% of its value. And therefore any depreciation taken in excess of 90% of the asset's value will still be subject, or will be disallowed. Great, moving on to the FILO agreements. You may or may not have heard of these. Lots of states have fee in lieu of tax or FILO agreements. Sometimes they call them payment in lieu of taxes. In South Carolina, we call them fee in lieu of tax agreements. But basically it's a discretionary incentive that can significantly reduce your property taxes for a 20 to 30 year period of time. So it extends way into the future. It's negotiated with and at the discretion of the local county councils. So this is not like the jobs tax credit, where as long as you are a qualified business and create the jobs, you can fill out a form and apply for it on your income tax return, but you do have to negotiate this benefit and get approval from the county that you are investing in. The minimum investment for a FILO project is going to be $2.5 million. And that $2.5 million can be either real or personal property and will need to be invested over a 5 to 10 year period generally. A typical agreement reduces the assessment ratio from 10.5% for a manufacturer. Manufacturer's real property is assessed at 10.5%, and personal property of all commercial and manufacturing businesses are assessed at 10.5%. So it reduces that assessment ratio from 10.5% to 6%, which is not a 4.5% savings, but a 40% savings, and allows the taxpayer to enter a millage rate agreement with the county over the life of the FILO. So usually you just lock in whatever last year's millage rate was, or there's certain situations where you adjust the millage rate every 5 years. But that's beneficial, obviously, for planning out your property tax expense into the future. Further benefits that may be negotiated are also special source revenue credits or infrastructure credits. And those are basically a direct credit that reduces your property tax liability. Here is a simplified FILO agreement example. Let's say that a company is investing $3 million in personal property under your standard. I'm not taking into depreciation here, so there would be depreciation applied, but under your standard property taxes, that $3 million would be assessed at a 10.5% ratio, leaving the business with an assessed value of $315,000. If the millage rate is right around 350 mils, the property taxes are going to be about $110,000 for that year. Alternatively, if that business had successfully negotiated a fee in lieu agreement with the county, that same $3 million of personal property is going to use the 6% assessment ratio. So the assessed value of the property goes from $315,000 to $180,000, and ultimately is going to save the company about $47,000 in that first year. And again, that fee in lieu agreement is going to be good for 20 to 30 years. Obviously, the fair market value of those assets, because it's personal property, is going to be reduced year over year due to depreciation, which is not shown here. But pretty significant savings when you're comparing regular property taxes to fee in lieu property taxes. So here are a few strategies for both PT 100 filers. So if you're in a non-manufacturer commercial business and you don't have a fee in lieu, Section 179 depreciation. If you're taking Section 179 on your income tax return in South Carolina, you can also apply that to your property taxes. Now, Section 179, generally fully reduces the value of the asset to zero for income tax purposes, you fully depreciate it. That'll be limited to 90% of depreciation for a property tax purpose. So you still have that 10% residual value subject to tax, but it can greatly save you, can greatly save on your property taxes as well as your income taxes. Note that South Carolina disallows the 100% bonus depreciation for income taxes. So therefore it would be disallowed for property taxes too. So just be careful and mindful of that. Just some easy ones that we often see missed when we pick up new clients or prospects. Companies really aren't paying attention to what they have, the assets they have listed on their depreciation report. Oftentimes there's old assets that haven't been used or they've gotten rid of a long time ago, but they're still paying property taxes on those annually. So it's just important to make sure that you're disposing of your assets in the year that they are no longer in service. Some quick strategies for PT 300 filers, some manufacturers. If you're expanding your business, if you're building a new facility, try and negotiate a fee in them. That's a huge part of property tax strategy in South Carolina, which frankly, South Carolina is probably one of the worst states in the Southeast region here for property taxes. We've got great income taxes, and there's a lot of great a pretty good tax atmosphere overall, but property taxes is where they make up a lot of their if we go back a little bit, Will. There we go. Sorry. A lot of their revenue. Another easy one is pollution control equipment. That's statutorily exempt. So if you have pollution control equipment, you shouldn't be paying taxes on that. If you're a manufacturer and you have a finished goods warehouse, you can reduce your assessment ratio on the finished goods warehouse significantly. So that's something you should be looking into. Also, if you are in manufacturing or in R&D, there are partial exemptions for those types of facilities as well. And you need to be making sure that you're following the right schedules on your PT 300. We're running out of time here, but I would like to cover very quickly the ATI exemption, as this is an often overlooked exemption that many people miss, many businesses miss when they're purchasing commercial property. The ATI exemption comes into play when a business or an individual is purchasing commercial property, which is commercial property before and after the purchase, meaning that it's going to be assessed at the 6% assessment ratio. When real property is reappraised on the normal 5-year reappraisal cycle, the appraiser is limited to increasing the taxable value of the property by a maximum of 15% of its current value. However, when there is a sale of the property, there is no limitation on how much the appraiser can reappraise that property for. The sale is also called an assessable transfer of interest event. So as you can imagine, if you've owned a piece of property for a significant period of time, it's going to, hopefully it's been appreciating. It's been capped by the 15% increase each 5-year cycle. Well, when you sell it, so that the new owner might inherit a piece of property that is worth, for tax purposes, significantly more than the previous owner. And therefore, the new owner is going to own a lot more property taxes. Can we go back to that, Will, real quick? There we go. So just real quickly, basically what the ATI exemption does is it reduces by 25% what would otherwise be the taxable value of that real property, as long as you basically file a very simple 1-page form with the county. We're running out of time, so I will just real quickly, run through this example. But basically, if there's a $500,000 piece of property that's valued at $500,000 for tax purposes, is sold for $750,000. Normally, that piece of property would be reappraised for $750,000, the sales price, and therefore would be taxed at $750,000. Well, if you file this 1-page form, for the ATI exemption, you can reduce that property's taxable value from $750,000 down to $562,500, which represents a 25% savings. Keep in mind that's an annual savings. So, $4,000 may not seem like a lot, but multiply that, in the future, and that quickly adds up. Great. I think that wraps up our property tax section then.
All righty. Well, cool. That was awesome on the property tax piece. Appreciate that, Nick. I do see that we have a number of questions that came in. Let's try to tackle those. And let's certainly open it up to any more questions that came in. I see the first question that came in was, can I receive a tax credit for working with a manufacturer? The manufacturer, added employees to make and package my products. So generally, the credits belong to the business that created the new jobs. So if a manufacturer adds new jobs to package your products, that credit belongs to the manufacturer. Certainly, you can do them a favor and make sure that they're they are taking that credit, remind them about it. But again, the credits belong to the employer of the employees.
Yeah.
Next, go ahead.
To go along with that, companies that utilize PEOs, those employees, since they're not technically employed by the organization, do not qualify for the credit either.
Yeah, that's a great point. So, great point there. All right. So, and if you have any additional questions on that, shoot us an email. Our contact information's up here. Next question is, what do we need to do to cover our basis on the R&D credit? R&D credit, that is a specific study. I mean, you really got to get into the nitty-gritty details on the R&D activities. Nick, I don't know if you have any more experience to cover that, but yeah, it's a very in-depth study for R&D. You'd want to certainly reach out to a professional CPA firm.
Based on what the question, I would say yes, you do need to be pretty specific in logging how your time is spent during the day, and it would probably be worth having even a separate account that is taking on your trial balance that is going to show your time spent on R&D activities versus kind of your normal salaries and wages related to any construction or other related activities that aren't going to qualify for the credit. So yes, do be pretty specific and keep track of what you're doing.
Nick, next one is can you readdress the amount of wages must be paid to employees to qualify for employee tax credits? For example, how much would be required if a daycare worker was hired? Nick, I'll let you take that one since you can help cover the job tax credits.
Yeah, sure, definitely. So that is all going to depend on the county that the business is located in. So twice a year, the Department of Revenue, South Carolina Department of Revenue, publishes a study that basically ranks all the counties and shows the wage levels, and they're used for multiple things other than just the jobs tax credit, but it shows the wage levels, the per capita wage levels per county, and also for the state. For the jobs tax credit specifically, the wage level has to be the lesser of either 120% of the county level or the state level. So if you're in a Orangeburg, it's going to be 120% of the Orangeburg County per capita wage level versus if you're in Greenville, it's going to be 120% of the state wage level, because Greenville per capita wages is higher on average than the statewide. Keep in mind, you mentioned daycare workers. Daycare workers are probably not going to qualify in most counties if you have a daycare business. If the daycare worker, that's a service provider, and they generally qualify only in the tier 4 counties if you have a daycare business. However, if you are a manufacturing company, a R&D intensive facility, and you happen to have childcare on premise, that person could potentially qualify. But just keep in mind, you have to be a qualified business as well to hiring the required number of jobs.
Yeah, and that's a good, interesting point there you have, Nick. The key here for that takeaway is that in a tier 4 county, those are the most rural counties in South Carolina. Those are the ones that need the jobs the most. Those rural counties, almost any business type qualifies. So daycare facilities would qualify. any legal business type basically qualifies in those rural counties. Those are your Orangeburgs, and any of those counties, those tier 4 counties, that they qualify. So if you have a business idea, if you want to start up a daycare facility in Orangeburg County or some of these other tier 4 counties, go right ahead and do it, because the job tax credits alone, I mean, $25,000 a pop for the employees, assuming you meet the per capita wage levels, that covers a significant portion of your payroll costs. So it's a great opportunity here, for the most rural counties for you to create new jobs in those counties. So we would encourage you to do so, and look into those counties. I mean, there's great opportunities in there for new businesses to come in and expand the workforce.
And keep in mind, it's not a refundable tax credit. It's limited to 50% of your tax liability. But if you are a daycare owner, you may own the daycare via a pass-through S corporation. Any wages you're drawing from that S corporation, even if the company's not showing a profit, you can apply the credit on your personal tax return to all the income that's being reported. Even if your spouse has a W-2 salary, that credit can be used to minimize whatever income your tax liability that you're reporting on your personal South Carolina return.
All right, last question we see coming in. Keep sending them in if you have them. Last question is angel investment credit. Can that be extended to an SPV which has individual accredited investors within its members? Yes, as long as everybody's an accredited investor and that entity meets the specific entity criteria, yes, you can have an entity that is a accredited entity investing in a qualified business. A lot of nuanced areas. Certainly reach out to your legal team, certainly reach out to your CPA firm to cover that, but big picture, yeah, that would work. A lot of other criteria that you need to meet and a lot of applications and other stuff to do, but certainly go for it. Great opportunity to get it done. All right, do we have anything else? Again, our contact information is up here. We'll be glad to shoot you the slides. Just send us an email. We'll be glad to send that out. And we can probably even get them over to Kelsey too. She can help us out with that as well. We appreciate everybody joining us today. It was great to talk on something that we're very passionate about. We love to speak on this. Excellent opportunities to expand business and create new jobs in South Carolina. So I don't see any other questions left. With that, we'll turn it over to John again and let him close us out. But again, we appreciate SCRA for hosting us on here today. And we look forward to working with everybody in the future.
Outstanding job, Will and Nick. Thank you for all that actionable information. Many thanks to you and to Elliott Davis for allowing you to be available to provide this to our participants. Thank you again for participating, and have a great rest of your day. Take care.